Good evening, everyone. Thank you for joining us today on our webinar, Navigating Volatility the VRDDHI Way. We are waiting for just a couple more people to join in on Teams and also on YouTube. We will begin in 5 minutes. Good evening, everyone. Thank you for joining us today on our webinar, Navigating Volatility the VRDDHI Way. Today, we have with us our co-fund managers, Mr. Rohit Balakrishnan and Rajat Setiya. I invite them to begin the presentation.
Hi, thanks, Poonam. Good evening, everyone. Thanks for joining us today on Saturday evening. The topic for today's discussion is how to navigate volatility in small cap space. We'll take you through how we at Vriddhi have been able to navigate this space over the last many years and how we have successfully done that. So jumping straight to the presentation, we'll begin with the small cap space. So what really makes small cap space an interesting space? So it is the illiquidity in this segment that really offers an opportunity for somebody to make outsized return. Because of lack of liquidity, there is very low institutional interest in this segment, and because of that reason, very few research houses, or very negligible, as you can see here on the charts as well. Very few research houses will cover this space. And that leads to market inefficiency because there isn't much information available. Now, for somebody who's willing to go out, roll up his or her sleeves, and then, one can really get to the bottom of the point in terms of researching an idea and find some opportunities where alpha can be generated. Now, let's look at some of the winners of the last decade. Uh, as we can see, there have been many. This list is by any means not at all exhaustive, but the moot point here is that all these companies were less than 1,000 crore in market cap 10 years back, and today some of them have gone up as high as 40-50x. So small cap space can really be a fertile ground for multibaggers. However, at the same time, the space is highly volatile. As you can see from the very long-term chart of small cap 100 index, it's almost 20-year-old long-term chart, 20 years of data. As you can see, this is no less than a roller coaster ride. So as you can see, I mean, 1 year up so much, the other year down so much, couple of years of continuous downfall, and then 2-3 years of continuous return making. So yes, this space is volatile. However, the same attribute of this volatility offers somebody who is prepared, somebody who has a long-term horizon, somebody who is willing to do the research and stick to a well tested philosophy, a philosophy that has worked over the years, somebody who is willing to stick to that philosophy and in a disciplined manner, willing to practice it, there are returns to be made. And this is what we will talk about. So how do we at ithought navigate small cap investing space given the volatility that it has? So these are some of the things which really help us in terms of navigating volatility. So beginning with our investment philosophy and research process. So what really is our philosophy here? It's 4 or 5 points, and at all times we really like to stick to them. This is what makes us, I would say, successful over the time. Now, beginning with, we want to invest in companies which are market leaders, which have been able to create some niche for themselves in whatever category or small subsegment of a broader industry they are operating in. Some of these companies, despite being a very small sized companies, they are market leaders, not just at India level, but at global levels as well. Because of this edge that they have been able to create for themselves in the niche segments that they operate in, they are able to generate higher margins. Those higher margins is what makes the business attractive and create some sort of moat around the business model. Then the second aspect is investing in companies which have very low debt or negligible debt. It is very, very important to not go with companies which have balance sheets laden with debt. And this is one of the important reasons why companies go bankrupt. If there is no debt, there is hardly a reason why you would go bankrupt. So this is another important aspect. And then another is partnering with companies which have a history of executing brilliantly in terms of track record, as well as behaving ethically with the minority shareholder. You don't want to partner with a crook. So it's something that there is a criteria, or I would say a long checklist which we practice, and we are able to avoid such companies and invest in good ones. And finally, I would say here is that how do you really create, if you get all the three aspects in a business model, then how do you really create uh, a win-win situation after that is like having some margin of safety, because no matter what you do, you will still end up committing some mistakes as you move along on this path. So how do you create that margin of safety? Is by buying that company at low valuations or at fair valuations. It is one thing to buy a company which is good, or let's say which is very attractive, but completely another that you buy that good company at good price. We at Vriddhi try to practice that at all times, and this has really helped us over the years in creating some alpha. So what is our investment process? As we embark on the journey of studying a company, what we do is we like to go through their past annual reports, their conference calls. So these reading of these con calls or the material that is available is gives you the opportunity to see the company progress through multiple years over the last many years, and you being a silent spectator from the outside, you see what's really happening, what is management saying, whether they are doing it or not. So this deep dive in terms of getting into the company's literature, whatever material is available, you do that, you read that, and you are able to eliminate many companies just by going through such things. Then you, another thing that you want to do is you get onto the ground and try to do some primary research. You try to connect with the ex-employees of the companies, customers of the company, or let's say somebody who is a supplier to the company, or the auditors, or the bankers, ex-management, senior employees, current management, competitors. Sometimes a competitor helps you understand who is the leader here and who is really well respected in the sector and why they are well respected. What are those attributes? So all those things put together, you are able to understand the company in deep. And you then also perform some forensic accounting test and some accounting test that you perform to, or let's say some number related test that you perform to find out whether management has behaved ethically or not in the past when it comes to behaving, treating the minority shareholders. So all in all, you want to go as deep as possible. Whatever information is available, you want to consume that related to that company or the industry or the competitors. And finally, like we briefly touched upon, was the checklist. We have a checklist-driven approach. We have developed checklist across various parameters, be it business quality, be it valuations, or be it how the business has performed on the numerical aspect, financial statements, and finally, how do we really ensure that you are partnering with a management team which has behaved, which has displayed good corporate governance attributes. So this private equity style due diligence is what we call. Rohit and I both of us come from private equity background. We started our investment career with one of the top finest of the companies in the space called Elevation Capital. We started our careers with that, and we learned the art and science of how do you really go deep into a company in terms of its research. And some of these alpha generators that we have been able to identify, all thanks to that process that we have been able to stick to, as some of the names are mentioned here. So now let's look at how does this philosophy applies in real life in our portfolio. So as you can see, majority of our companies are market leaders. They are debt free. One of the major reasons why companies go bankrupt is having debt. 13 of our almost 22 companies that we own in our portfolio, they don't have debt at all. Rather, they have a lot of cash on the books. So this is another. And finally, I mean, as you can see, 16 of the companies do not have any research coverage on them. Now let's move to the second important aspect of how does one really navigate volatile small cap space. It's basically having a very strong risk control framework in place. Some of the points we have already talked about in terms of how do you ensure that you're not partnering with poor corporate governance management, business quality should be top notch, and how do you really avoid, one should really avoid expensive valuations. Some of the risks we have already talked about. Let's talk about the much talked about risk is which is like volatility and the discussion for today, topic for today's discussion. So we at iThought don't really see volatility as a risk. Rather, we see this as a friend, something that can be leveraged if you are, if you have done your work, if you have done your analysis, and if you know what you are really doing. So this volatility basically is what? It's ups and down movement of a stock price. And friends, we are not talking about stocks underlying business. We are talking about stocks price underlying movement. So those movements may or may not have to do anything with the underlying business of the company that we may be invested in. So those movements in a short period of time may happen because of many reasons, and sometimes they are not at all related to the business underlying business of the company in discussion. So those opportunities, those moments offer you to invest in a company at a very attractive valuation. And if you are able to do that, you are able to generate some alpha. And only that who has a long-term horizon will be able to do that. Somebody with a short-term horizon will always see volatility as a risk, but we at iThought, like we said, we don't see it as a risk because we have a very long-term horizon. And here on this slide, we will talk about something really interesting, and that is so far we have talked about what we do. Now, what we don't do is equally important. And in the words of Mr. Charlie Munger, a great legendary investor of our time, he says, all I want to know is where I'm going to die, so I will never go there. So what are those things, some of those things that can kill us as investors? And these are some of those things. And we as investors, uh, do not really fall for these things. We try to stay away from them as much as possible. And this is another thing that really helps us in terms of staying on the course. The other important aspect in terms of how do we really navigate this volatile space is having a long-term horizon. This really gives us an advantage, comparative advantage over majority of the participants in the market, because majority of the market is really focused on short term, which is probably next 3 to 4 quarters. And having a long-term horizon gives us an opportunity to participate in the market at different levels. Sometimes when prices are falling, you are able to average down, and which is a fantastic thing. And another thing is that when you understand a company better over a period of time, then you are able to generate higher conviction in that company, in that business, and accordingly allocate more capital. So having a long-term horizon, really having a long-term horizon then really helps you there. And as you can see, churn in our portfolio in the last 12 months has been around 6%. So this is a testimony to what we are talking about. Now, this is finally another aspect, another weapon in our arsenal in terms of how we really navigate this volatile space. And this relates to the capital deployment strategy that we have at iThought. So we don't really deploy all our capital on day one. We have a model portfolio, like in the industry, which usually follow model portfolio approach. We don't do that at Vriddhi. What we do is we curate every client's portfolio as per the prevailing market conditions at that point in time when the money comes in. Through this example that we have shown here on the slide, you can see that this is the live account from the portfolio, Vriddhi portfolio. So as you can see, we took almost an year to deploy the whole of the capital that we received from the client. We took almost 1 year to deploy this capital, and we were able to take, I mean, whenever if markets gave us the opportunity to, when markets were falling, we were able to take them in our favor. So not deploying all the capital on day one really gives you an advantage as you develop conviction over time in a particular stock or number of stocks that you are tracking, and then you slowly average out. Now let's look at how we have done during the tough times in the markets, times when markets are falling. And friends, the true test of a portfolio is happens when markets are really falling. So risk control embedded in a portfolio is exposed when markets are down. So whether you are able to save some money during those times or not is what really matters. And this, if you look at our portfolio over the last 1 year, when markets were in a downtrend, Nifty Small Cap Index has fallen by around 11%. During the same time period, Vriddhi portfolio is up 10%. And how did that happen? We have already talked about it in detail in the previous slides. Some of the things I've mentioned once again here. This slide we would really like to emphasize as this is really one of the most important aspect of investing. You have to look at investing as something which has two sides of it. One is risk and one is returns. So during the bad periods when risk really shows up, you need to control those risky parameters and be able to outperform. So this is where alpha is actually generated, because in an up market, it is very difficult to distinguish a high risk portfolio from a low risk portfolio because everything is going up. When everything is going up, everybody looks smart and everybody is making money, and very difficult to distinguish which one is a high risky portfolio and which one is not. But during the down markets, if you are able to curtail your losses lower than the markets, that's where you have done your job. That's where you have created alpha, and that alpha that you create during this time period will really help you create sustainable alpha over the long period of time, say 4 to 5 years. This chart basically shows since inception returns of Vriddhi. As you can see, 100 rupees invested with Vriddhi would have become 142, and 100 rupees invested with Nifty Small Cap Index, Small Cap 100 Index would have become 108. Vriddhi was inception date is 7th May in 2021. Quick uh, quick scorecard of fundamentals of the portfolio in FY22. Majority of the companies hit their all-time high revenues, EBITDA, and PAT. So very good results in terms of the fundamentals on a full year concluded, which was FY22. Some of the winners that the team has been able to identify over the last few years. This is again not an exhaustive slide. Some of the names that we have mentioned here. Now, through this slide, through this case study of a company, TD Power, which is in the Vriddhi portfolio, we'll talk about how we have been able to implement so many points that we have talked about with regards to our philosophy and our investment process, and how markets really test you during the bad times, and how did we behave during those times, and you navigated those volatile, tough times. So this company is TD Power. We invested in this company somewhere in 2018 and early 2018. At the time of our investment, the reason why we invested in this company was it had cash on books. There was no debt. It is a market leader in its space where it operates. Then management over the years displayed brilliant execution track record in terms of scaling the business or diversifying from being one product and one geography company. And finally, the valuations. It was trading at or below one-time book value. And it is a manufacturing company. It is not a lending company that, book value is a real parameter. But despite being a manufacturing company, it was available at one-time book. That means it was really, really cheap in terms of its valuations. So all these things put together, we really like the company. We invested in this in early 2018. As you can see, over the next 2 years, company's sales, as you can see from this table, company sales improved from 430 odd crores to almost 500 crores. Margins improved from 2.5% to 7.5%. So drastic improvement in terms of underlying fundamentals. But let's look at what really happened in the stock price. 2 years of flat performance, and during this time, COVID hasn't hit us yet. So 2 years of flat performance because market was in overall correction phase during that time. So company stock, despite performing fundamentally, despite improving its profitability or growing in revenues, stock was flat. It was even down for majority of the part, but net 2 years, it was, let's say, flat. So here is a company that has all the winning aspects, is growing as well, yet stock is flat. So you always doubt yourself. You go back to the blackboard and try to understand whether you have got it wrong or you are missing something. But every time we did this manthan chintan, and we got with the outcome that we're probably not missing anything, and it just that market is being irrational. Uh, Another aspect why we could hold on and what we really did was that we were tracking this company for 2 to 3 years prior to really investing in it for the first time. So we started tracking this company in somewhere in late 2015, and we invested only in early 2018. That means almost for 2.5 years we were tracking this company. So that tracking closely tracking of the company over the years and interacting with the management through every conference call, going through past annual reports, and doing the plant visit and meeting the company management in person really helped us to hold the company during the tough phase. And what happened after the first 2 years of our holding period? COVID happened, stock fell another 50%. Since we had done our work, we were ready with our analysis, and our analysis always showed us that there is nothing wrong. Rather, falling of the price is a buying opportunity. So what we did was we started in this company in 2018 with just 2% allocation in the portfolio. And over the next 2.5 years, or 2 to 3 years rather, we increased this 2% to 10 to 12%. This again goes back to the point where we said we deploy slowly when the conviction is built. And we were very sure that the company is really moving on the right path. So we increased our allocation to 5 to 6 times of original allocation. And all in all, outcome has been pretty rewarding for us. And today, TD Power continues to be the top holding in the portfolio. So now moving to the final segment of today's presentation, and that is a point which is much often asked about from us. Ki market kaisa lagta hai? How do you see the market? Is today the right time to put money, especially in the small cap space? So let's look at some of the indicators. It's very, very difficult to predict the future because it's all about future, and nobody has a crystal ball. So it's just not possible to tell what's really going to happen and how precisely things will play out. But what you can do is you can go by certain patterns. You can go by certain data points and what those data points are indicating to you. Now let's look at some of those data points. So this is a chart for search term multibagger. See, small cap is mostly associated with finding multibaggers. And so is clear from this chart that people search a lot about multibaggers whenever small cap index is going up. And the search term comes down drastically whenever market starts falling. So as you can see, markets have fallen a lot from their peak, which was made somewhere around October 2021. Markets have fallen a lot. It's been almost 1.5 years of, you can say in a different way, you can say it's a bear market in small cap space or mid cap space. Markets have fallen by somewhere around 20-25% since then. And as you can see, multi-bagger term such has also come down. Now, this is another data point, which is basically a long-term data point. This is 20 years of data. This is a ratio that we have plotted, a ratio of Nifty small cap index and Nifty 50 index. And as you can see, whenever the number is around 0.4 to 0.5, markets generally form their bottom. And today's number is somewhere around 0.53. So we are definitely, as per this data, we are definitely, and the previous slide. So putting these two slides together, we are definitely in a zone where it can be termed as an investment zone or something which is worth investing. And returns from here onwards for the keeping in view next 3-4 years of time, as you can see, whenever markets have bottom, it has taken some time for money to be made. Again, from here till here. So in the next 3 to 4 years, we can expect good money to be made going by these charts. But once again, the same caveat that these are just indicators. They don't really point out what will really happen. They are indicators, and they are just showing us how things have panned out in the past. Well, zooming out a bit, we have talked a lot about specifics of how we operate, how the portfolio has done over the years, how the companies in the portfolio put together have done, how the revenue growth, profit growth. Now let's zoom out a bit and look at India story. So as you can see, Indian corporates have deleveraged balance sheet at the moment. Consumption is booming. NPA cycle of the banks is subsiding, which means they are once again ready to lend to the corporates. China plus one is really helping us in terms of our manufacturing. World is shifting away from China a little bit, and that little bit is a lot for countries like India, where our market share is very low. Some initiatives taken by the government in terms of tax incentives for the new unit, PLI scheme, Make in India, all these things are really, really visible on the ground. And all things put together, uh, we can see that the outlook for India manufacturing is the brightest since our independence. Since the time India got its independence, the outlook for manufacturing sector has never been so bright. And we really believe that in the next 5 to 7 years, we will go through a very good time. We are really well placed in the global economy because of our intrinsic fundamentals. We don't really depend a lot on exports. We depend on our own economy, domestic consumption. Now, some final thoughts, putting everything together. Like we talked about, small cap is a rewarding yet volatile space. But if you have a process, if you have a framework in place, and you're willing to stick to that framework in a very disciplined, rigorous manner, then you can navigate this space profitably. You need to have long-term time horizon. You need to have that risk control framework in place. And our philosophy, our framework of backing high quality market leaders, run companies run by ethical and capable managers, and you buy those companies at attractive valuations, fair or value at bargaining price. That's when you are able to generate some alpha. And over time, portfolio has displayed superior risk-adjusted returns, especially during the market correction, because that really forms the bedrock of generating alpha in the markets. Because in good market, everybody does well. And how we have seen that India story is getting stronger, and every volatility in the next few months, which we believe is going to be a volatile time, will be a entering opportunity, will be a buying opportunity. And we believe that because markets have corrected a lot from the peak that was made in broadly in October 2021, we believe current prices and how we have seen some of the indicators, broader indicators like search term and the ratio that we plotted for 20 years, all things put together, we see current valuations are attractive. But for somebody who has a long-term time horizon of 4 to 5 years, we believe that markets are going to be rewarding from here onwards. And with that, we'll take a pause, and we are open for any Q&A that you may have. You can put your questions in the chat box. Thank you so much for patiently hearing us. If you have any questions, Rohit and I are more than happy to take them. Please feel free to ask anything related to investing in general or small caps investing in specific.
Mr. Hardik, I see that your hand is raised. I request you to type your question in the chat box. If there are no questions, we can wrap up the session for today. And if you have any questions that you'd like our team to answer, you can always write to us at pms@ithought.co.in, or you can give us a call and we'll get in touch with you again.
No, I think Mr. Hardik had some question, right? He had raised his hand.
Yes. Mr. Hardik, do you have a question?
I think Mr. Veeramani also has raised his hand.
Sir, I request you to type your question in the chat box.
Yeah.
So that we can, take a look at your question and answer them.
Yeah, Mr. Hardik and Veeramani, you can just type your question in the chat box. I think that will. I don't know if you can give the mic to them because. Okay. Can we give the mic to them? Is it enabled?
Yes, I'll just enable it in a minute.
Yeah, maybe that will be quicker.
Yes, Mr. Hardik, your mic is enabled. Please go ahead.
Hello. Am I
Yeah,
audible?
Mr. Yes, you are.
Thank you for an exciting session. I just wanted I had some questions regarding the charges of our PMS, and the thing is that is it can we register in the name of HUF in this PMS, or it has to be an individual only who can subscribe?
You can register in the name of an HUF.
Okay. Thank you. And what are the charges in the first question?
Yeah, so I'll give you maybe somebody from our team can sort of explain it in detail because there is a nuance. So there is there's a yearly management fee of 1.5% and a performance fee of 15% over a hurdle of 8%. And there is a high watermark which also compounds. So what is this high watermark compounding? I think it is important to understand because not many people in the industry probably do this. So hence it's important to understand. So I think if you can maybe get in touch with us, we can explain that. That's what I was saying.
Definitely, I'd like to get in touch.
Yes, Rohit, we do have your contact details, sir. So I'll forward it to the team and I'll ask them to get in touch with you as soon as possible.
Thank you so much.
I'd like to add one point. Do understand about high watermark, which compounds, and our team will explain that to you. It is very important to understand that aspect because that is really the crux of our fee model here, and that is something that we take pride in terms of this fee model that we are offering to our clients.
Thank you. Thanks a lot.
Thanks for asking your question and joining us today.
Thank you. Good day.
You too. Thanks.
Hello, I'm audible?
Yes, sir.
Hello. Yeah. Thank you for the session, actually, Rajat and Rohit. And yes, actually, first of all, the chat box is disabled. Okay, we are not
Oh,
able to
okay.
type the questions. Yeah, and followed by, I have a few questions as well, actually. Yeah, so the first one is, yeah, what is your, so if since, I'm also one of the subscriber of the plan, actually. I'm an NRA. And yeah, I wanted to know that, what is your accumulations? How low you look for to, I mean, you got it right. Like, if the script has crashed 15% or 20%, or if it is in a script in a momentum. So how, what is your accumulation strategy actually? Because of, I've seen in my portfolio there are reds, a few stocks in like a sideways, and few stocks in, they have crashed actually well. So I would like to know your strategy here. And second question is, yeah, as a investor, where are you investing your own money? Actually, I would
Right.
like to know. Yeah, if you enable
So,
your chat box, I can type further
sure,
questions as well. Yeah, thank
sure. So, I'll answer the second question, which is a straightforward one. So we invest in the same stocks as that we are sort of investing in Vridhi for our clients. So our portfolio, both Rajat and mine's portfolio, is exactly the same as that of Vridhi. And I think Shyam is also one of the largest investors in Vridhi. So we are sort of aligned on that. In terms of our accumulation strategy, so I think there is uh, it's driven more by our conviction in that company and how that business is evolving. So it's not that if it has fallen by 20%, we'll always buy. In the example that Rajat gave, it was a scenario where the business, in our view, was improving and the price was counter to that. So we just kept on buying. In the same business, we also averaged up, where we thought that, let's say we bought it at 100. These are just hypothetical numbers just to explain explain the thing. And the stock went back to 60 and we kept on buying. And then when it came back to 100 again, the outlook was even better. Or if it went to even 120, the outlook was even better. So we even bought at 120. So in the same stock, we have averaged down and averaged up as well. Specifically, one, as Rajat was mentioning in his presentation, that we look at the business underlying. That's the most important. Stock, it's an outcome over a longer period. Obviously, in the short period, stock price movement can go anywhere. So we don't really give too much of credence. If we feel that probably the business is challenged for a few, let's say, quarters, and we feel that maybe there is more downside, even and despite the fact that, let's say, we bought it at X and it's at, let's say, 0.8x now, and we feel that there is more chance of the business to go sideways, or there is some trouble, some temporary issue. And if we can get a better opportunity, we'll probably stagger our buying or buy slowly or not buy at 0.8x, because at any point in time we will have opportunities. We have to optimize and see which is a better better company at this point of time. So it's not so much to do with just the price. While price is very important, but I think business performance and what we feel about the business is equally important. That's what I would say. Rajat, you want to add something?
Just a small point that prices that Rohit mentioned for TD Power 168, those were prior to basically the split. So that split happened. So today's price is 160. So just to put that into context. Yeah, nothing else. Nothing else.
Okay, thank you. Okay, one more doubt I have actually is, since in recent the recent RBI monetary policy meeting, they have the rate hike, they have put on hold actually. So as a like a stock analyst. So what is your view about the further like a rate hike? Whether this be expected the rate hike, because this helps me to I'm as a I have some few investments in FDs as well actually. So I am just I mean FD, I mean NRI FD, tax-free FD. So do I need to wait to wait for the rate hike, or is this or about the RBI monitoring for the rate hike actually, whether it will be happen or not, or what is your expectations in this area? Yeah.
So I think honestly, it's a very tough question to specifically or precisely answer. Even if you look at last few days, there have been interviews by the people from MPC committee, and they've given a clear guideline what they are watching, right? So if the inflation comes closer to the desired target of 4%, even if it is not 4%, but even if that's what the MPC members have given an interview and they've spoken about that. So I think the outcome is very hazy still. It's still not clear. I think if there is going to be, I mean, if let's say crude oil goes up, the inflation continues to persist, then probably we will have this pause may have to go back again, and we will have to again see maybe they'll raise interest rates. So I think inflation is what we need to see. I don't know, but what was definitely good to see from the Reserve Bank of India and the MPC committee is the fact that this cognizance that we are in a very strong wicket and we should not starve or stifle the economy by just doing what the other Western economies are doing, because we did not do what they were doing when things were bad. So I think it's a very pragmatic approach. What they're saying, they're not just focused on following what others are doing. I think they are very pragmatic in the sense that if the inflation data is good, in the sense that it is coming down, then I think we should be okay. So I think two, three things we should monitor rather than predicting what they will do. One is definitely the inflation levels. Second is, I mean, things that we import, for example, uh, uh, crude, etc., which we can track. And third, I think monsoon will also be very important because that will drive a large part of the economy in terms of rural wages and income, and also food prices. So these are two, three things we need to sort of closely monitor. However, again, while you ask a question specifically for your for your investments in fixed investment, but I'll also take this opportunity to answer something which probably you may wanted to understand. While interest rates are very important, what we have seen is that over a 3-5 year period, uh, the micro will trump the macro, and what is probably the worst time to invest will, in hindsight, look the best time to invest. If you go back in September 2013, or even before that, between September 11, or I mean, between 2011 and 2013, as a country, things were very, very bleak for us. We had a lot of corruption issues, growth was stalled. Uh, we were having the current account deficit impact. And in September 2013, Raghuram Rajan came in as a RBI governor, and from there the currency was in a tailspin, and he sort of made that defining speech, and things became better. But if you were to go back and see, things were not very uh, positive. But that was the best time to invest, and post that, things became better and better. Markets got re-rated. And there are so many such examples. I mean, closer recently, obviously, there was COVID, which was again something similar. So we are more focused on the immediate, not so focused on the immediate thing, but more on the 3, 4, 5 year view about the business, because we tend to like to invest in companies which are fundamentally strong. And bad times actually, as Rajat was mentioning in his presentation also, that bad times actually help these businesses to gain market share from others. They can survive because their balance sheet is very, very strong. They are cash rich. So yeah, I just thought I'll also add. Rajat, you want to add anything?
Just one thing that the interest rates, if you look at the history of interest rates in India, they have obviously been just like any other economy, going up and down, up and down. However, markets, if you see over a long period of time, the trend is like that. Obviously, I'm talking about trend. I'm not talking about the markets. Markets are always like that. The trend is like that. So interest rates will be the way they are. In India, they have the way they have behaved, or outside the way they have behaved, cyclical. Sometimes economies get heated or they become very troubled. So, RBI or the central banks have to act accordingly. But a strong business, which Rohit just mentioned, will become even stronger during those times. So we need to be positioned for any sort of shocks that can happen in the economy, and then accordingly future decisions that RBI or other governmental regulatory bodies may take with regards to the economy, correcting the economy, safeguarding the economy. So our job is to be in a business which can withstand the shocks that can happen in the economy and to the business itself. Business shouldn't go bankrupt during those times, because that would mean that your investment from 100, whatever you invested 100 in that business, will become zero. You don't want to be with such businesses, and if you are, let's say, then you want to get out as soon as you identify that probably this business is no more as resilient, or you are wrong, plain wrong. You can be wrong, so you are plain wrong, or the competitive edge that the business had is no more the case, so you get out. Those things keep on happening. Business environment is ever dynamic. It's very, very dynamic, just like in real life of any person. So we need to be sure that we look at these things, macro things, be it interest rates, be it inflation, be it the war outside India, be it so many other aspects playing out globally. Those things have always happened, will keep on happening. But if you look at, let's say, Nifty 50 or Sensex, or rather, if you want to take a very long-term data, look at S&P 500 outside India, which is US broader index. A lot has happened in the world wars and pandemic now and so many other things. But equity markets, they go up. Why? Because it's a productive asset. It's a productive asset. It will generate, it will grow, and share price is nothing but a slave of the business fundamentals. So if your profits are growing, share price has to go. It can take some time. It doesn't necessarily will go in the same time period that the profits are going. We saw that with TD Power case study, right? For after we invested for first 2.5 years, stock was rather down and profits had gone up. So just like that, for every a common thing for equity market is that these things are true, and we need to be concerned, or we need to take those into our account, interest rates and macro things. But if we have found out the businesses which are strong, then we will be able to sail through such tough times. Rather, those tough times do offer you the opportunity. You need to be selective. You can't blindly deploy capital in all the companies at the same time. When markets are in a tough phase, you need to segregate best ones from the average ones, and then you selectively allocate. That's what.
Okay, thanks once again. I have one more doubt actually. Here, since our GDP forecast is in a good shape, and everybody is expecting that next decade is for India. I completely agree. Actually, there are lots of even your slides, also one of the slides explained about that. But at the same time, the INR is weakening day by day actually. So why there is a contradiction actually? GDP perspective, it is good, but at the same time, INR weakening on every day basis. How this gives impact into our particularly like based investments, or generically like a stock, equities actually. So what is your view about INR weakening? How that will give impact to our investments, or like overall stock market? Yes.
So historically, if you see, I mean, again, on a long-term period, probably over the last 15, 20 years, I think Indian rupee has depreciated over against US dollar around, I mean, 2 to 4%, I think. Around 3% if my memory serves right. Obviously, this is not every year it will depreciate. It will depreciate very fast, maybe in a year, and then be there for a few time. And I'm just saying on an annualized basis, that's the broader trend. And it is, I mean, it's as the, I mean, a weaker, see, it's, I will not go into a lot of technicalities because there are a lot of stuff, I mean, it will be very technical. But if you, as long as we are not undervaluing our currency and we don't keep our currency artificially depressed, or at the same time, if our fundamentals are strong, are weak, and we've seen some of the countries, especially in the last 1-2 years, where their currency has gone into a tailspin, their trade deficits, current account deficits are very, very weak. Those things are very much in shape for India. I mean, they are very, very good. So I think we should broadly think what history has done, probably will be somewhere around that. And in terms of us, for us, I mean, many of these businesses, of the flavor that we typically look when we look at businesses from India, which are good businesses, which have spent time in their niches and they've become stronger and stronger. They are competing globally with their peers, and the fact that they are based out of India gives them that competitive advantage, and currency is also a part of that. So in general, that has been the overall. I mean that's what I would say, that history has done about 3% depreciation, 3.5% depreciation over the many years. I think between INR to USD, that should broadly continue. And we are not in a situation where we should be worried too much. At least at this point of time, things obviously can change, and everything is dynamic. But we are in a very good situation. We have very decent forex reserves. Our overall export share is expected to grow. In some sectors, it's already growing. So all those things will help this situation of INR to USD. Anything to add, Rajat?
Yeah, I would like to share some data points here. So first of all, what happened? These currency movements happen in chunks. So few months of high volatility, up or down movement, largely let's say down movement for us. Like we are always in a depreciating mode. Over a long trend is depreciating for INR. So, strong movement in a period of 5 to 6 months, and then stabilization or fall, and then another small movement, another big movement in a small period over the next 1-2 years. I would like to share some data points. So in August, 30th August was the day, I think, when Rajan was selected as the RBI governor. That day, I think our USD INR touched 67 for the first time. And it had depreciated, INR had depreciated by around 25% in a matter of just, it was sometime in May, it was 53 rupees or 54 rupees. So 25% of depreciation in a matter of 3.5 months. And our macros were really in very bad shape. And that day, I remember 30th August 2013, Raghuram Rajan was selected as our governor, RBI governor. Now, markets were in very bad shape as well during that time. Nifty 50 was below 6,000 during that time. Now, fast forward to that time, 30th August 2013, we are in 2023, broadly 10 years, 9.5 years. From 67, which was the low point for INR, it was just few months back, it was at 70 to 75, whatever range. So in 10 years, sudden depreciation of 25% in a matter of 3-4 months. And then for 10 years, well, let's say 9+ years, it was at around 75. Now, again, a sharp movement has happened. INR has depreciated by 10-15% in the last few months. However, let's look at Nifty 50. What has happened to Nifty 50? So overall, from that day, 67 to today, which is 9.5 years, 82, which is a difference of 15 rupees, broadly another 25%, less than 25% actually. But what has happened to Nifty? Nifty was at less than 6,000 bucks. I mean, level was less than 6,000. Nifty is 3x up, and we are talking about bluest of the bluest blue chip company in India, which is Nifty, index. 3x in 10 years, which is not at all a bad return, keeping in mind where you are investing. So yes, these things will keep on happening, but data clearly shows us that if you are invested in good companies, because Nifty 50 by itself is a self-selecting index wherein bad companies are thrown out and good companies are selected in. So that way, Nifty 50 is a decent index of decent companies, very good companies rather, best of the best companies in India. So if you're invested in good companies, you will be able to make money. So like we just said, I mean, depreciation of 50, 25, again 25% has happened recently. It may look like a shock in the recent history because it's recent times and we are seeing a sharp depreciation. I mean, 15% depreciation. But the data says that these things have happened in the past, and equity being a productive asset, it offers the opportunity to grow over time.
Okay. Yeah. I got it actually. I mean, I have one more. Okay, one feedback actually. In your slide, the Google search about multi-bagger, there is one slide actually. This is it still seems, it is not updated. It is still shown that, the data is still available for till January 2023. So we are in April. So is this will be updated in next meeting?
I think this is, I mean, broadly, I mean, this is again it's not something that we track on a monthly basis as such. It's again just to see the broad temperature of the market. I mean, this is not something that we are looking at on a weekly or a monthly basis. Broadly, the mood of the market is revealed in these things. And while we can update it, but I think the general idea to sort of show these things is just we are not basing our decisions based on this one metric or these two metrics. They're again just to show the broad temperature of the market. Are we in a very hot zone or are we in an investable zone? So while we take that feedback, we'll see wherever it needs to be updated, we'll update it. But it's not to see that it's like it's gone up so much or it's come down so much. That's not what we're trying to do. It is what I want to sort of share.
Okay, thank you for that. And yeah, one more. I have one expectation that can we expect your competitor comparison chart? For example, with the small cap PMS versus your competitor. Can this be expected in further meetings, further team? I mean, discussion.
I think you. So I will say 2-3 things, and maybe Rajat you can add later. See, one, while your expectation is fair, and we can definitely provide data on that. But I think one needs to understand that's the output. Without understanding what is going behind the output, it is very important to understand that part of how one is doing, how the returns are generated. I think that is what something I'm not saying that we should not share it. It's important to understand how the returns are generated and what kind of risks are taken. So that we cannot sort of, I don't know what others are doing. While a number itself may not reveal much, a static number. And any comparison has to also has to be also like apples to apples. Because the starting point where you're comparing, the end point where you're comparing, all those have to be kept in mind. So I think tend to not compare ourselves because these are very specific strategies that we try to follow, and there is not much we can glean out of just comparison. We focus on what we do, and I think that is what we want to do going forward. While you have all the right to compare us and ask questions, and yeah, I think you can check with the advisors; they can definitely provide you some data. But my point is, like, I would want to sort of be compared on things which can be compared in terms of process. Alone, the returns may not be the right metric that should be compared. While you may think that this is the thing that can be compared or that can be measured, so it should be. I wanted to just add that point because it's extremely important, because in a year, somebody has made returns and somebody has not made returns. It's important to understand how those returns were made, and it's very difficult to also understand because anybody can say anything. But more focus should be on the process, how the decisions are being made, how the risks are being managed in the portfolio. So yeah, that's what I would say. Rajat, you want to add?
Yeah. I mean, see, data is available on pmsbazaar.com. Our all ithought products are shown there, their performance, whatever the format, like 1 month, 3 months, 6 months, and it is one can compare Vriddhi and other products at the same time with the peers to the time period that is reported there. Like Rohit mentioned that, you know, we don't really know what others are doing. Others don't know what we are doing. Risk framework, risk control, or risk, embedded risk in a portfolio is what is really that matters. We would love you to compare us during down times specifically, that, you know, how did we do and how did anybody else did. Issue comes is you don't get those point-to-point data. You only get specific reported time periods. We would, from your end, this is a very genuine question. But it is just one part, and rather the output part, which is like returns. In fact, from our side, we would rather do and focus on those risk control parameters, because in an up market takes care of itself, portfolio takes care of itself, everybody does well. We need to do well during down markets. And to do that, we really need to be focused on what works for us, and something that is working for us that has worked for us in the last 10, 12 years. We want to improve upon that incrementally every year, with every decision or that decision, let's say decision that goes wrong, then you introspect and you are able to then further improve on your process. We want to do that. And over time, we want to be sure that in every market correction, we are able to better from the past time, and ultimately not fall as much as the market, rather fall much less than the market, because that's where alpha is really getting generated. And in any year, we never compare ourselves with anybody, and we would never want to do that. This is our side. We are not saying you don't do that. We are saying internally, this is how we operate. And the reason for that is we don't want to get into that zone where we are, driven by some of the outperformers in a particular year. Rather, our satisfaction lies in, or our philosophy matches with, we doing average in every year. If we are if we are even amongst the average every year, but for the long term, let's say for 10 years, we will be much above the averages. We will be probably in the top percentile in the country, because consistently staying around the averages automatically puts you in the top percentile category over a long period of time. We would, if we are on top in any of the years, we would love that, but that's not what we are aiming here for. Because to be at the top, you don't know who you are competing with. There are all sorts of strategies in the market: high risk, low risk, medium risk. We don't want to do that. So staying at the top or amongst the top, we never aim for it. We just aim for protecting our portfolio and understanding the companies and making decent returns. And if we do that decently every year over a 10-year time period, we know we will be much above the averages. and we'll be very, very happy with the outcome. We have already spent last 10, 12 years in the markets. We are pretty, we have been able to beat the markets, and we're pretty happy with the outcome. And we tend to, we intend to follow the same philosophy, which has obviously improved a lot, tightened a lot the process and the framework. And we hope from the new mistakes that we will do, we will tighten it further, and we'll continue doing. And data is available on pmsbazaar.com.
Okay, I really appreciate your answer. I mean, both. Yeah, and do you have any IT small cap stocks in your radar because of, the INR weakening, and also the recent, I'm seeing some everywhere layoff is going on. Also, there are crashes happening recently. It's happened, crash in our market actually. So do you have any IT specific small cap stocks in your radar? And by any chance, you will accumulate or you will include in my portfolio in future? Yeah.
So we definitely track that sector very closely, and there are many companies which we are looking at. At the right price, we will probably, at the right price that we think is. So we are tracking a lot of companies. Probably, I cannot say we will or we won't, but yeah, we are genuinely tracking a lot of companies in that space, and in the past we have done well there, and hopefully we'll get another opportunity.
Okay. Thank you. Yeah, I'm done actually.
Thanks for your questions and your interest. Thank you.
We really appreciate you joining us. I think if we are not wrong, you had joined us during the last webinar as well, and you had recently started your account with us back then, if we are not wrong on that information. So thank you so much for joining us, and we really would love to. We would really love if our clients monitor our progress in terms of our process, how we are doing in a short period of time. Markets can make you look like a lucky one or somebody with a hard luck, but it is the process that matters over a long period of time. And we would really want you to first understand our philosophy, our process, and so that over a period of time, as you move along with us in the journey, you are able to judge us in a better way, whether we really walk the talk or not. And then obviously outcome number, returns number is always there, but it is in a short period of time, it is the process that really matters, and the comfort with the fund manager that your alignment or the way you think in terms of risk and returns, you are aligned to the fund manager. It is really important, and we really thank you for joining us on a consecutive second webinar. And you have once again, you have any questions, would really take that. Yeah.
Yes, actually, yeah. See, about I have joined previous webinar as well actually, and your slides looks like it's repetitive actually. I'm not seeing new slides. It is not updated. This is the one thing. And second thing is, can we expect possible to post your failure case actually? So which probably you can show your case study that, hey, this is our failure actually. We have wrongly we have chosen this, and we have made a mistake, and we have come actually. So because we have seen so many of your the good case, the past case actually, also to see the failure case as well. Yeah, that would be nice. Question. And yes, I'm done. And yeah.
Sure, we'll probably. Sorry, Rajat. Sorry, you were saying something. Go ahead.
Okay. I was saying actually nothing really changes in a 1 month's time period. So, so that's why nothing else. That's why we didn't update the slide. Nothing really changes. One month is a very short period of time. However, when it comes to the second point that you have raised, soon we'll be completing our 2 years, and we do intend to have a detailed presentation, and definitely a different presentation for all our clients and this will be more from the point of view of reaching out to all our clients and showing them how we have done over the last 2 years since we started Vriddhi. Soon we'll do that, and that will definitely have a big section on our mistakes.
And in general, I think we'll probably also try to say can do something. We'll take that as a good feedback and see. Yeah, thanks. I think if there are no other questions.
Thank you. Have a nice.
You too. Thank you.
You too.
So if you have no other questions, we can close.
Okay, yes. So thank you all for joining us today. If you have any further questions, you can always reach out to us via email. I'll drop the email ID on the chat box. So you can anytime reach out to us and we'll be happy to help. Thank you.
Okay, thank you very much.
Thank you.